Lesson 3.3 talks about transactions that affect the owner's equity account. And before we review how to record those, I wanted to go over how things are affected by owner's equity. So if you remember, we have capital is our main account. Capital is the account where the owners puts money into the account, and everything, the balance in capital belongs to the owner. Since our assets equal liabilities plus owner's equity is on the right-hand side of the accounting equation. Therefore, capital will increase with a credit, because credit means right. So it increases with a credit, and it has a normal balance of a credit. So in chapter 2, we threw in a couple of snags to our whole rule of that owner's equity is on the right-hand side of the accounting equation, increases with a credit because credit means right. We threw in a couple of glitches to that. First of all, sales. Sales is when you do the service that your business does or you sell your products. And so that is money coming into the business. We call that revenue. Sales will increase our capital. Therefore, sales follows the rule. It goes up with a credit and has a normal balance side of a credit. That's not the hard part. Then we threw in expenses and drawing. Expenses or drawing are money going out of the business from the regular operations of the business. That is an expense. Drawing is when the owner takes assets out of the business, because if you remember, I said that in a small business, a lot of times the owner doesn't pay themselves a regular paycheck, but every once in a while they will withdraw cash or assets from the business to pay themselves or for other reasons. Both expenses and drawing are going to decrease capital. Capital decreases with a debit. Therefore, our expenses and our owner's drawing account are going to have normal debit balances because they decrease our capital, and capital decreases with a debit. Eventually, the balances of these accounts are going to be subtracted from capital. And so therefore, they have debit balances. So as we go into our transactions, the first one, received cash from sales. We're going to have that calculator tape. When we record a calculator tape as a source document, you're going to use the date as the number. And so we'll get to that in just a second. So again, our two accounts, we received cash. So cash goes up with a debit because it's an asset. Sales goes up with a credit. So our date of the 10th, our cash is our debit. Our sales is our credit. And then the source document, we're going to use T for tape and the date. So T10. Again, sold services. This time we just didn't get cash when we walked out of the door. We're going to bill them and they're going to pay us later. So we sold services on account, still a sales transaction. It's just that the debit side of that is going to be accounts receivable because now Main Street Services owes us money. So it's an account we're going to receive money on, therefore accounts receivable. Accounts receivable is an asset. So again, we do our date, our accounts receivable debit, our sales credit, and this time, because it's not a cash register tape, it's a sales invoice, because we fill out that sales invoice when we sold it to them. So this is going to be S1. Paying cash for an expense, communications bill, cell phone and internet service. Communications expense is going to be our debit. Remember from what I said a minute ago, expenses decrease owner's equity, so they have a debit balance, and cash is going to go down with a credit. So we have the date, the 12th, communication expenses, the debit on the line, cash is the credit, and our check number C4. We're going to pay another expense, and this just shows you how they go down in the journal. And so same thing, this one's just equipment rental expense.